Hello, good morning and welcome to this edition of Buy Now, Sell Now on ET Now. I'm Cheryl D'Souza along with Mubina Kapasi. And Mubina, our markets are all set to snap that 4-day losing streak. But let's take a look at what are the top headlines this morning that we are tracking on ET Now. And like I mentioned, we snapped that 4-day losing streak. It is the tech, it's the realty sector and the FMCG sector that are actually moving ahead in the trade today. Apart from that, you have Reliance Industries that is in focus. It is one among the top gainers in trade. It is pushing the Nifty higher as well. KKR has agreed to invest 5,550 crore rupees in its retail unit, and this is marking the private equity's second major investment in its business. Moving on, you have the Telecom Tariff War in forefront once again. Jio has ramped up postpaid plans, and that's one of the reasons why Airtel is nosediving in trade today, down about 4.5% in trade, top Nifty loser. Talking about the Tata versus mystery, the spat there, and SP Group is saying they're keen to separate from the Tatas. They're saying they're willing to sell their stake in the group in order to settle the legal issues. On back of that news, if you see, the Shapoorji Pallonji Group stocks are surging in trade today. And let's talk about the border issue with that's the LAC border issue. Is India and China have agreed to not send additional troops to the border. So these are the top headlines that we are tracking this morning, Mubina. But how's the market shaping up?
Well, Cheryl, like you mentioned, we look like we are going to snap that losing streak that we were posting in the last couple of trading sessions. So we have the Nifty that managed to rebound above the 11,200 mark, 0.6% higher. And the SENSEX is just a couple of points short of the 38,000 mark. Technology is really the cynosure of all eyes yet again. We have an Infosys, HCL Tech, all of them, gaining around 2% So great going for the technology pack. Asian Paints as well is gaining roughly 2%. Reliance Industries, we had that news around KKR. L&T higher by 1.7%. But among the losing names, it is the utility names. Tata Steel that's losing 2.7%. Even a Bharti Airtel that's down around 4.5%. That's possibly got to do, possibly, of course, with the new launches on the postpaid packs by Reliance Industries. So the whole competition bit once again perhaps playing in on a Bharti Airtel 4.5% down. Tata Steel already flagged off, Grasim, NTPC and Adani Ports. So largely it's, I think, the utility names, infra, oil and gas, that are on the losing side. Interestingly, I think the market is being really held up purely by technology names, which you have the IT index that's gaining roughly about 1%. So that certainly is quite an interesting sign. So let's take forward the market conversation with our guests for today. We have with us Kunal Bothra on the technicals and Gaurang Shah joining in of Geojit Financial Services. Morning, gentlemen. Kunal, let's go across to you first. Just a day before expiry, we've seen it's not been that great a week, especially for the bulls. But today, a bit of recovery kicking in. Do you expect some more volatility over the next two trading sessions? And of course, also share with us your high risk and low risk ideas.
Choppiness to continue. It could be possible that the markets may probably go through some bit of more downward drift as well, at least in terms of individual stocks, because we are clearly seeing some defensive buying as a pattern which is shaping up on the overall market. So start right from the start of September series or September month, you saw the Nifty IT stocks doing exceptionally well. They're managing to do still pretty well. Nifty pharma stocks individually as well. I think the large caps as well as the mid cap ones are also doing exceptionally well. And I think today you're seeing some flavor and some signs of the FMCG stocks also trying to make a good comeback. So I think this is a clear shift towards defensive, and wherever there has been a shift towards defensive, the markets have remained more lackluster, at least in terms of the indices. So I believe that the tone for the end of this expiry, which is tomorrow, as well as for the start of the next expiry, would be on a slightly cautious note, and completely different than what we've seen the last week, right?
All right, Kunal. And Kunal, what are your high risk and low risk ideas for viewers for today then?
Well, Cheryl, two buy calls. First, the bank Deepak Nitrate, a mid-cap name, stock looking extremely strong on the daily charts. It's still perched at its 52-week high levels. approximately. So I believe that the stock still shows some extremely strong momentum, even in a choppy market like this. So I would suggest that as a buy, more of a high risk trade. Targets of 940, stop loss to be kept at 830. As I was mentioning earlier, that ITC is one stock which I believe is showing some signs of strength again. So I think today's bullish candle is something which is very interesting. The stock is on the verge of a breakout of some technical indicators on the early time frame. So if that gets confirmed, which is around 178 levels for ITC, then I believe a gradual uptrend could begin at least from the very near term. So a buy on ITC about that 178 level, targets of 184 and stop loss 173.
All right, so that's of course, the big moves and shakers. Deepak, Nitrite actually has been seeing a lot of momentum in the last couple of days. We've had Vanguard as well buy some shares in this counter, and Kunal as well is keeping this one on his radar. Gaurang, over to you then. Anything that you're observing on the IT pack? Just want to get in your take on that. It's not just the large cap names, but even some of the mid cap names. Like I'm seeing a lot of traction in a KPIT tech. So what's your view, on what could be a possible trigger in technology stocks back home? And if you could also share with our viewers your high risk and low risk ideas.
Thank you, Mubina, and morning to all of you. So IT has been a preferred safe bet given the backdrop of events that our market is witnessing. And this despite the fact, Mubina, that you've seen a relatively stronger rupee vis-a-vis the dollar. Having said that, I think whatever earnings we've seen for the last financial year, last quarter, and this financial year, first quarter, I think they've been much better than what the estimates were. And the understanding and belief is that the next quarters to come by for this financial and the financial years to follow, the earnings could be much better and there could be recovery. At least that is what we've heard from the verbatim that the management has shared. So we at Geojit, we do have preference towards large cap IT, but if you actually go to see mid cap ITs have actually outperformed some of the frontline IT names. And in the mid cap arena, if you will, I think one of the stock that has been a stellar performer is Mindtree, and it's despite the environment in the backdrop, this stock has actually hit a new 52-week high. So we have preference towards Mindtree, both the twins from L&T Infotech and L&T Technologies. We like NIT Technologies. We like stocks like Persistent Systems. And of course, if you will, Tech Mahindra. HCL Tech has been an outperformer. So our sense is that IT and pharma will continue to hawk the limelight in this volatile time. And along with that, I think on the market front, well, tomorrow is the expiry. So today, tomorrow, you'll see choppiness. Next week, when we come back for trade, 28th September, that is Monday, we'll have the outcome from the Honorable Supreme Court as far as the banking sector, NBFC interest on interest matters concerned. So we may say a little bit of choppiness and volatile, but these corrections are great time to nibble into some quality names. And from a long-term perspective, low-risk ideas, two of them. First one, like I rightly mentioned, the banking private sector bank, Axis Bank, extremely positive on this one. Long-term targets of somewhere close to about 685. And the next one is from the cement pack. And given the monsoon now withdrawing and construction activity coming back thick and thin, along with the government spend as far as Bharat Nirman is concerned, we believe one of the mid-cap cement names in form of Dalmia Bharat Limited, that is Dalmia Bharat Cement, could see a fantastic traction, great distribution network, great distribution dealership and great market share. Long term, would not be surprised the stock scaling highs of 920. Now both these are fundamentally long-term investment ideas, so the investors need to have at least 18 to 24 months time horizon.
All right, and those are the high risk and low risk ideas coming in from our expert this morning. So let's get on and let's get our first query for today. And the first query is coming in from Jay Patel from Delhi. He's saying that pessimism seems to be priced into the financial space. He wants to know whether he can invest into the Bajaj twins as Bajaj Finance and FinServ at the current market price. Kunal, talking about the financial space, if you talk primarily about Nifty Bank, definitely is underperformed compared to the rest of the sectors. But does it make sense at this point in time to look at Bajaj Finance as well as Bajaj FinServ? Is it an attractive buy at this current market price?
So the answer could be yes and no, but the outcome of this will probably depend on your time horizon. I think that's going to be one very important feature. And what is your strategy? Even if you have a time horizon of long term, where do you just want to buy at this price and hold? I think the strategy would depend. The answer would depend on the strategy which the viewer would be adopting. So my take is that both Bajaj Finance and Bajaj Finserv are now a good set of stocks from a very long-term view. Now, we've seen how these stocks crumbled under some severe selling pressure in the month of February and March. I think, for example, Bajaj Finance from 4,800, 900 levels fell to as much as 1,900 levels. The stock is now recovered back to 3,300. So, there is some semblance of recovery in Bajaj Finance as well. But whether the entire selling pressure is out, I still believe that there could be a case where many of these stocks, could probably go through, more of a downward drift or a downward grind for some bit of more time, maybe for another few quarters before they see some signs of revival. So your time horizon has to be long term. Your strategy has to be to try and buy these stocks on significant dips. And by significant dips, I mean at least a 15 to 20% dip. Is where you need to keep on averaging these stocks, because there could be a case with that. Because these stocks have gone through a sharp correction, and that correction generally would play a ripple effect into the stock prices. I would probably expect that for the next couple of quarters, the stocks may either lie a bit low or there could be more downward drift into the stock price. So from a short-term view, I believe your strategy has to be try and buy the stock at every 15 to 20% dips. So at 3,300, the next tranche of buying you can do, probably the stock comes back to below 3,000 levels, and then subsequent to those kind of 15-20% corrections. But your time horizon has to be long term, at least a 3 to 5 year plus time horizon is warranted when you're looking to buy both these names.
All right. Well, that's, of course, Kunal's view on financials. And yeah, I guess Gaurang, Bajaj Finserv and Bajaj Finance have been immensely popular among investors for the right reasons, right? I mean, the enormous wealth that they have created. Jay Patel, however, believes that even from your own, there is room to rally. But do you think that, Gaurang, it can ape the kind of returns it did in the last decade?
So, Mubina, from the lows of March and April 2020, both the twins, Bajaj Finserv and Bajaj Finance, have recovered quite significantly. And in fact, in the entire NBFC pack, if you actually go to see, they have outperformed the peers. And if you have to, reflect on the commentary post the first quarter numbers from both Bajaj Finserv and Bajaj Finance, it definitely gives you a comfort zone. And by and large, I think these are the stories that will definitely outperform, keeping in mind the large part of business model which is focusing on rural and semi-urban India. So if you do want to buy into both these stocks, first of all, you can definitely go and buy. My only request would be that given the volatile and choppiness in the market, don't go and put all your money at one time. Start with an initial investment of maybe 25-30% of whatever you want to invest. And when you see dips coming into the market, you can go on adding into it in equal parts. So in effect, like in the 3 to 4 parts, you could exhaust all your investment. At the same time, by following this strategy, I think you will get a decent average as well. But I definitely recommend to get into both of them from a long-term perspective. I'm quite sure there is going to be tremendous improvement as far as earning is concerned.
So if you're a long-term investor, go ahead and pick out Bajaj, these two stocks. That's Gaurang's recommendation. Okay, moving on, we have Sahil Sharma from Pune writing into us saying that he bought 500 shares of Bharat Forge at 458 rupees per share. The stock has corrected a little, but now more or less it's remaining flattish. He wants to know if he should add, sell or hold. Kunal, the stock price of Bharat Forge has been in this very narrow range for the last couple of years. It's not really done much for investors. What would be your take?
Well, yeah, I believe that Bharat Forge looks attractive, moving on the charts, and I think at 450 odd levels, since your buy price is at exactly these kind of levels, the stock has completed a mean reversion process. Now, from those March lows, the moment the stock had broken that 50-day moving average, it actually restarted an uptrend for itself. post that the stock went to uptrends, it came back to touch its 50-day moving average, bounced off from those levels yet again. So this is a sign of a typical trend in the making for stocks like Bharat Forge. So which is why I believe that maybe the current levels of 450 approximately on the stock is also a similar indication that a mean reversion process is just about to get complete. Maybe for another couple of days, the stock may remain a bit sideways. But I believe there could be a possibility that this trend should continue for Bharat Forge on the upside. So I would suggest a hold for the viewer, and would expect that if this trend continues, then generally and typically the previous swing highs are the ones which generally get taken out whenever you see a resumption of the new trend. So if the resumption of the trend happens for Bharat Forge, then I believe that a 520, 515 level could be a possible or a fair target for the stock price, given the fact that that was the swing resistance just about 2 to 3 weeks back.
All right, hold is a call coming in from Kunal for Bharat Forge. Gaurang, let me get your view in for Bharat Forge. 500 shares a viewer has bought in and at around 458 rupees per share. So do you suggest him to add on to it, sell or hold?
Well, Cheryl, first of all, auto ancillary is a reflection of what auto sector does. And given the slow recovery of space in the auto sector, auto ancillary will be much more slower in terms of recovery. Add to it, Bharat Forge specifically, Cheryl, has dependency on exports, especially the American markets as far as their Class 8 trucks are concerned, chassis are concerned. And then you have the slow recovery of commercial vehicle segment in the domestic market, subject to, of course, that long-awaited scrappage policy comes through. Then I think there are better times both for auto manufacturing companies as far as CVs are concerned, and for companies like Bharat Forge who are largely engaged in light, heavy commercial vehicle parts and equipments. So there is a positivity, but what I'm trying to say in effect is that the road to recovery will be longer, slower, it will be painful. So if you're willing to take on board all these, advisories that is coming through, then first of all, hold on to the stock. And given the price correction, if you have investable amount, maybe 50% could be averaged at current level, and gradually you can average furthermore if you get correction. But please bear in mind that the recovery in auto ancillary sector will be slower, painful, and for Bharat Forge, it could be a long drawn affair.
How Gaurang said, need to keep in mind that Bharat Forge is an auto ancillary company, and that is a reflection of what is happening in the auto and indirectly a reflection of what is happening in the economy. Let's shift focus. Let's talk. Let's get on board our next query, and it is Harshit Bhatia from Cochin who's written to us. He's saying he's bought 1,000 shares of ICICI Bank at 370 rupees per share. He wants to know whether he should add on to the stock or hold the stock. Kunal, what's your view on ICICI Bank, a better bank compared to the rest in the private sector as of now, if you see, apart from HDFC Bank? So what would you advise our viewer to do with this particular stock?
So yeah, I think I'll completely agree that it's a better quality bank. There are, I think, very few in large cap banks which have good solid price action as well. When you look at the chart structure, so I think ICICI Bank, of course, fits into that kind of a category. But then the outlook would be that I would expect the stock would remain in a bit of a downward drift for some bit of more time. Now that we've bought at 370 levels, I think first things first, the time horizon has to be more from longer term view because of the current volatility which you're seeing in the bank Nifty and the overall banking name. So it's possible or highly probable that many of these banking stocks could probably drag a bit lower before they start to see some very strong and solid recovery. Now, in that regards, I believe ICICI Bank has a major support, at least on the medium-term charts, which is around this 325, 330 zone. The stock is now at 350. You purchased at around this 370 level. So my advice would be that if the stock comes back to this 330-ish kind of a zone, I think that is where you should look to average further. And then I think your time horizon has to be long-term, because I believe that's a very important and a strong support zone. Even if you look at charts and the last 6-7 months of price recovery for ICICI Bank, it's been in an upward trending fashion, and that trend support for ICICI Bank happens to be closer to this 330 level. So I would suggest wait for this 330 level for ICICI Bank, and that's where I believe we should look to average further.
All right, Gaurang, let's get in your view. ICICI Bank bought at 370, and it's quite a big amount, 1,000 shares purchased. What would be your opinion? Is this one of those private sector banks that you would pick out?
Definitely agree with that, Mubina. And given the earnings turnaround for the last couple of quarters, this is one of the banks that could possibly be heading towards higher levels on fallback of earning visibility. So first of all, on fundamental side, Mubina, we always advise investors that don't park large sum of your investable capital into a particular sector or a particular stock, because then you end up overexposing yourself. Having said that, if this investor has got high risk appetite and a long-term time horizon, first of all, hold on to the stock. And if you do have investable amount, and if you're willing to take a larger exposure on this particular private sector bank, then I think any price point closer to 325 or below would be a great opportunity for all those investors who have got into ICICI Bank at higher levels, and even for those who are looking to make fresh investment in this private sector bank. So we do have a positive coverage. If you are in for the long haul, hold on to it. If money or your pocket permits to average at lower levels for a long term, you can definitely do that.
All right, great. So that's the recommendation coming in on ICICI Bank. Before I let you go, Kunal, chart busters. This is something that you've been identifying for us every day. So what exactly is the chart that you believe, is something that everybody should take note of today?
Nifty IT space. So yesterday we were discussing about the Nifty auto stocks or the auto index, and today I'm highlighting Nifty IT index. As you can see on the charts, I've marked 3 shaded regions for the Nifty IT index. It's an index which has a tendency of going through periods of rallies and then a prolonged bit of a rectangular correction or a rectangular consolidation. You can see on the charts as well that there have been 3 zones of consolidation, each of them lasting for approximately around 1 month for the Nifty IT index. Now the current zone as well is where I believe that there are some consolidation patterns for Nifty IT index. If there's if you look at the second chart as well in terms of prices, there's a price in a relative strength index comparison. So on this chart you can see that how the prices have made a higher high, but the indicators, that's the RSI, has actually made a lower top over there on the upper grid. That's an indication of a bearish divergences, which means the prices are moving up higher, but the momentum is decelerating, or the acceleration, or there's deceleration in the indicators. That generally calls in for some bit of cool off or price correction. Now combining both of these charts, it indicates that 18,500-ish zone for the Nifty IT index seems to be now a very strong support. So for anyone who's looking to buy or add on to their Nifty IT index and wanting for good support levels, I think that support zone of 18,500-ish on the Nifty IT index, I think is a very strong and important support zone. I think that's where I believe stocks like TCS, Wipro, HCI Tech, Infosys, etc., they could come back to their key support zones and key support levels and could become a very attractive buyer from a longer term view.
All right, thank you, Kunal, for taking us through that chart buster, and that is the Nifty IT index that is mentioned in the chart buster segment of Kunal. With that, thank you, Kunal, as well as Gaurang, for joining us and resolving the viewer queries, as well as giving us your views and your trading ideas. And on that note, we'll slip into a break on this edition of Buy Now, Sell Now. Stay tuned, more on the other side.
Hi everyone, welcome back. You're watching Buy Now, Sell Now. Well, a reminder for all our viewers, every day we throw at you quizzes and mind teasers on various aspects of trend spotting on the Lal Street via our BNSN question of the day. So the BNSN quiz question of the day is, which of the following banks has the lowest gross NPA ratio? Is it A, HDFC Bank, B, Kotak Mahindra Bank, C, AU Small Finance Bank, or D, City Union Bank? To participate, you can log into our Twitter page and tweet to us the right question. We will reveal the answer as well as who the BNSN quiz champions are in just 15 minutes from now. So start tweeting and stay tuned.
All right, now let's shift focus on to a top story this morning, and also that is the Reliance Industries. If you see that the news flow that we've got on that particular front, it is that KKR will be investing 5,550 crore rupees in its retail arm, that is Reliance Retail Ventures, giving the unit a pre-money valuation of about 4.21 lakh crore rupees. So that on back of that particular news, if you see, look at Reliance Industries up over 2% in trade today. So talking more about what the deal is, this is a second investment by KKR in a Reliance subsidiary. KKR will be investing, like I said, 5,550 crore rupees in Reliance Retail Ventures. That will translate into 1.28% equity stake in the company. So after Jio, it is Reliance Retail that is in focus. You had Silver Lake also come out with an investment. Now it is KKR that is actually investing in Reliance Retail. You have Mukesh Ambani also, who is given a quote on this particular thing, on particular development, I beg your pardon. KKR has a proven track record of being a valuable partner to the industry-leading franchise and has been committed to India for many years, is what Mukesh Ambani is saying. He goes on to say that we look forward to working with KKR's global platform, industry knowledge and operational expertise across our digital services and retail businesses. So that's the big headline this morning that we've got, and that is KKR will be investing 5,550 crore rupees in Reliance Retail Ventures.
All right, well, that's of course Reliance Industries. You know, Sharon, we've often been saying that it looks like Reliance is doing a Jio with retail as well, and now with KKR too, picking up a stake. Let's see how things turn up, but definitely the war now perhaps seems to have shifted to retail. Okay, well, moving on and keeping it with Reliance and how it has essentially really made things difficult for its competitors. This time around, it's doing so by ramping up offerings in the postpaid segment. Let me go across to my colleague Vinny Motiwala for more details.
New battle lines drawn in the telecom space as Jio has ramped up its offerings in the postpaid segment. Now, normally postpaid segments will bring them high premium clients as well, and also will lead to an improvement in their ARPUs. They've launched a Jio Postpaid Plus plan, which is very attractive. With the prices are lower than Airtel and Vodafone Idea, as well as they have additional offers of free, Netflix and Disney Hotstar subscription for most or all their clients. So that is something very attractive and may pull in customers from Vodafone Idea and Bharti Airtel to Jio. Even the prepaid customers maybe could shift to postpaid as well. Now, what does postpaid actually do for Jio? Obviously, postpaid customers usually have a higher ARPU, so that will be something that we'll see over there, that the ARPUs could, move to improve, and this move will improve the ARPUs further. Also, currently Jio's postpaid subscription contributes only around 1% of the overall postpaid subscriptions, so that could start seeing an increase if the more customers shift into postpaid. And TRAI has also said that postpaid ARPUs are 3x that of prepaid, so that is why we're going to see a considerable improvement in the ARPUs of Jio, and this is a move to improve their ARPUs as well. Now, who is at risk currently? Bharti Airtel, who currently accounts for around 5% of the overall subscription, as well as Vodafone Idea, who accounts to 8% of the overall subscription of postpaid plans. They could see an impact, as well as overall contribution for Bharti Airtel from postpaid is around 15 to 16%, while for Vodafone Idea it's 22 to 26%. So that is something that is surely going to see an impact, and they could see some pressure because of these attractive plans by Jio. Now, what could happen further now? That Bharti and Vodafone Idea likely could respond with similar offerings or something attractive for customers, as well as the tariff hike buzz which we are hearing, that could be pushed in the near term. So these are the near term impact that we could see in the telecom space currently.
All right, Vinny, thank you so much for that. Okay, well, moving on, here's the big story. It is, you could call it the end of an era, as the Shapoorji Pallonji Group, which is owned by the billionaire Mistry family, told the Supreme Court that it would exit Tata Sons, provided an early fair and equitable solution was reached. Remember that the SP Group is one of the largest minority shareholders in the company, owning around 18% stake, which is valued at roughly 1.8 lakh crore rupees. And yes, remember that it's a 7-decade-old stake that is owned by the Shapoorji Pallonji Group. Remember that the Supreme Court as well had essentially restrained SP Group and Cyrus Mistry from pledging or transferring shares till the 28th of October. And now the SP Group has told the Supreme Court that it's time now to part ways with the Tatas. We caught up with a whole host of stakeholders and experts on this, Mr. V.R. Mehta, Mr. Anil Singhvi and Tushar Cooper, to understand their take on this tussle.
This looks like one of the many moves that Shapoorji Pallonji Group and Mr. Mistry in particular has made to throw spanners and to hurt the interests of the Tata Sons and the Tata Trusts, which he has been doing even while he was in the office as chairman, and later when he was removed because of lack of confidence in of the board, when he lost the confidence of the board of the Tata Sons, when he was removed. After that, he went to the extent of releasing for public consumption information, confidential information, which no right-thinking person would have done. Secondly, the matter is now sub judice with the Supreme Court. And what is the time for this, starting this new issue, is just to put pressure on the Supreme Court. I mean, these are tactics which anyone can see. So I don't think this is a move which is in the interests of the Tata Sons or the Tata Trusts. And in any case, the last point I would like to make is that he has floated just a proposal. What is this? What is the specific proposal? I don't see that in the statement that is issued.
It's more like it's a partnership situation. And when you look at the Articles of Association of Tata Sons, I think it makes it even abundantly clear that it is a partnership. So whenever a partner wants to get out or retire, he has to offer his stake to the other partners. So this is exactly what SP Group is doing. Because if you look at last 4 years, the bickering going on between the two groups, I don't think it beholds on any part that they can continue to have litigation and engaging themselves on that. So I think it's a very gracious point of view which SP Group has taken, having taken the matter to Supreme Court. Tatas have really now taken also that they can't pledge the shares, they can't sell the shares, they can't do anything. So it's much better that okay, I bow down to all this.
Yeah, basically the SP Group holds its stake in Tata Sons. So, of course, Tata Sons would have to buy out the SP Group stake. You are right when you say that the price of those shares is a pretty stiff or a steep one. I'm not sure whether Tatas would absorb the entire shareholding themselves or whether some sovereign funds may buy some stakes in those shares, or how this will be worked out, I'm not quite clear. But at the end of the day, according to me, this is the only viable solution which can be found to this dispute between the SP Group and the Tatas. I mean, it is the only practical solution.
Moving on then, the dollar index has risen back above 94 level and touched a 2-month high. And how does this actually impact commodities as well as equities? My colleague Jayesh is here to take us through the ET insight and also the details on this. Jayesh.
There are a few things that I want to highlight while looking at the chart of the dollar index. One is that it has now crossed above its 50-day moving average, which could be a positive sign for the bulls. Second is that there has been an inverse head and shoulder pattern that the dollar index has made, and we are now trading above the neckline of that pattern as well. The third point being that if you draw a trend line which is declining from the recent high that we hit from 100 plus levels, there could be some resistance near the 95 level. However, once that is crossed, we could see an accelerated up move coming in for the dollar index. Of course, let's also have a look at how all of this will impact commodities and equities, starting off with its correlation with the commodity space. Let me just highlight that precious metals are the worst impacted because all three precious metals, gold, platinum as well as silver, these have a negative correlation coefficient of about 0.4 to 0.5 times when you look at the 50-day correlation for the last 10 years or so. And then you have, of course, Brent oil along with copper, which also has a negative correlation of less than 0.4 times, but that too can be adversely impacted. Moving on to the equity space, we all know that the dollar index moves inversely proportional to the emerging equity space as well. Earlier in the year, we saw the decline in the dollar index, which led to a massive rally in the equity space as well. But that looks like it will change very soon because there has been signs of a breakout in the dollar index. And you can see that, one of the worst impacted markets in the past has been Brazil, where the correlation coefficient is minus 0.4 times. And then you have Hong Kong along with China and US also, which has a negative correlation of minus 0.2 to minus 0.3 times. And lastly, you have the Indian markets also, which are negatively correlated to the tune of 0.1 time based on the 50-day correlation in the last 10 years.
Note, we'll slip into a break on this edition of Buy Now, Sell Now, but stay tuned, more news and more updates on the other side.
All right, hi everyone, welcome back. You're watching Buy Now, Sell Now. Well, it's time to reveal our answer to the BNSN quiz question that we asked you, as well as who the champions are for today. Just a reminder, we asked you which of these banks have the lowest gross NPA ratio, indicating that their asset quality is pretty decent. Is it HDFC Bank, Kotak Mahindra Bank, AU Small Finance Bank, or City Union Bank? Well, the answer is A, HDFC Bank, one of the darling stocks of especially long-term investors, of a lot of fundamental experts. It's been a great wealth creator as well in the last couple of years. And yes, one of India's largest private sector banks, HDFC Bank. Also, I guess it's really a big positive to have a bank that does have one of the best asset qualities and the lowest gross NPAs. So that's HDFC Bank for you. And here are the champions for today. We have Pankaj Kumar. His Twitter handle is @KumarPankaj INF. Nikesh Gogia too has got the answer right. And Shadab, who is found on Twitter at SM Shadab Kalam. These are in fact the three champions who got it right before anybody else. We had a lot of participation today, but these were what we could call as the fastest finger first. So congratulations to our champions for today. And folks, don't fret, we'll be back tomorrow with yet another BNSN quiz question. So stay tuned to Weekly Now.
All right, and now let's get your market veteran's voice on how to get rich. And we spoke to Atul Suri and got his insights on how to get rich. So listen in.
Markets are a game of probability. If anyone says that, I know that stock that's going to make you rich, believe you me, he's lying, or he's dumb. The fact is that after having spent so many years in the market, this is a game of probabilities. You have a few bets, you be overweight, underweight somewhere, and you ride the trend. That is what I have really learned on. There is no one silver bullet or golden bullet there is. You just have to keep your risk under control. People think creating wealth is all about picking that one stock or some tip. But, it has so many more components. Yes, picking stocks is one bit, but what percentage, how do you allocate? You can be wrong, and you're going to be wrong half the time in this market. Where do you exit? So I think managing a portfolio or creating wealth is a sum total of all these. when you study the biggest investors or the most successful investors, you really get shocked at how the 80-20 principle works. That 80% of the wealth is only created by 20% of the stocks. And it's this ability which really, I think, differentiates, or if there's one such stock idea, or if there's one such strategy, it is this whole 80-20 principle. And repeatedly, you hear George Soros talk about it, all great investors. I mean, even the great Warren Buffett, the biggest wealth creator. Ultimately, you will find that it's concentrated portfolios. In his 90s, maximum wealth he creates in a stock is Apple. Just imagine what this market teaches us.
And PhonePe founder and CEO Sameer Nigam has backed his arch rival Paytm in this fight against Google. In an exclusive interview to ET Now's Chandra R. Srikanth, he said that Google's policy may be consistent, but they aren't right. And he also said that the CCI is falling short. Nigam also said that Google plays house dealers with 6 to 8 seats at the poker table. Listen in.
I think if you're asking me if they've applied them consistently, I believe they have. If you're asking me if it's right, I believe it's not. And those are two very different things, because the policy is being defined by a team that's not sitting in India. Repeated pleas on our end over the last year, we've had at least 4 or 5 takedown notices. And every time it goes, our request for a hearing goes into a sinkhole. We've had one from Apple in the past, and we got a response from their policy team within 48 hours. There's a huge difference. The reason it's relevant, that the right or wrong of it is relevant, is that they are a natural monopoly here. Monopolies, especially national monopolies, are not evil. It just means that they have the best OS or the right OS match for a market like ours. But it does mean that there needs to be a redressal mechanism where they respond. I don't think borders matter, by the way. Even if they responded from the US or UK or wherever, that'd be fine. I think the second question is, can the policy of a natural monopoly prevail over the law of the land? Now, this is where it gets very tricky. Normally, any company can say, these are my house rules, and that's fair. But when you reach a 95% plus monopoly situation...
Well, here's a programming reminder for our viewers. The new normal. How exactly is India preparing for the same? We are conducting a survey of India's resilient enterprises on the Never Say Die spirit. This will be the IRM Business Perception Survey, and you can catch this special coverage live on ET Now this Saturday. So don't forget to tune in. But with that, it's a goodbye from Cheryl, myself, and the entire team that put the show together. Thanks for watching.